Let's go back in time for a moment. The date is January 16, 2016. You are sitting at your old computer, reading a forum post about a digital currency called Bitcoin. It is trading at roughly $430. It feels risky. It feels like magic internet money. But something about it clicks for you. You decide to take a leap of faith. You invest $5,000. Fast forward 10 years to today, January 2026, that $5,000 investment isn't just an investment anymore. It is a fortune. That single decision has changed the trajectory of your entire life. You are looking at your portfolio and you see numbers that look like telephone numbers. You have survived the brutal crypto winter of 2018. You held through the COVID crash of 2020. You didn't panic sell when FTX collapsed. You earned the title of a diamond hand. But now, you are facing a new enemy. An enemy that doesn't care about decentralization, an enemy that doesn't care about the blockchain, and an enemy that is far more ruthless than any market crash. I am talking about the tax man. Most people think the hard part of investing is holding the asset. They are wrong. The hard part is getting out. Here is the brutal reality that no one talks about during the bull runs. If you have been holding Bitcoin for 10 years, you are sitting on a massive pile of unrealized gains. The key word there is unrealized. It's paper money. It's a digital score. The moment you decide to turn that digital score into a house, a car, or even a cup of coffee, you trigger a chain reaction within the tax system that could wipe out 20%, 30%, or depending on where you live, even 50% of your wealth instantly. Think about that. You took all the risk. You did the research. You held through the sleepless nights, but the government, who called it a scam 10 years ago, is now waiting at the finish line with their hand out, demanding their share of your vision. If you sell blindly today, you are volunteering to pay the maximum price. But if you understand the code, not the Bitcoin code, but the tax code, you can legally save tens, maybe hundreds of thousands of dollars. In this video, we are going to do a deep dive into the mathematical reality of exiting a long-term Bitcoin position. We will cover the hidden FIFO trap that ruins most investors, the surprise surtaxes like the NIIT, and the legal loopholes the wealthy use to pay zero. This is the most important financial video you will watch this year, because it's not about how much you make, it's about how much you keep. Welcome to Crypto Market Views 24. Let's dive in. Let's start by destroying a common myth. A myth that lands thousands of crypto investors in hot water with the IRS every single year. Many investors, especially those who have been in the space since the early days, treat Bitcoin like a currency. You might think, I'm just swapping my money from one form to another. Or perhaps you think, I'm not cashing out to my bank account, I'm just buying a Tesla directly with Bitcoin, so I don't owe any tax. Let me be crystal clear right now. In the eyes of the IRS in the United States and most tax authorities across Europe, Bitcoin is not currency. Bitcoin is property. From a tax perspective, owning Bitcoin is legally identical to owning a piece of real estate, a stock, or a bar of gold. This brings us to the most critical concept you need to master, the taxable event. You need to understand exactly when the tax clock starts ticking. There are three main triggers that long-term holders often misunderstand. Trigger number 1, selling for fiat. This is the obvious one. You send one Bitcoin to Coinbase or Kraken, sell it for US dollars or euros, and withdraw it to your bank. This is a clear capital gains event. You calculate the difference between what you paid for it 10 years ago, your cost basis, and what you sold it for today. That difference is your profit, and it is fully taxable. Trigger number 2, trading for another crypto. This is where 90% of people get it wrong. Let's say you have 10 Bitcoin from 2016. You decide you want to diversify. You swap one Bitcoin for Ethereum. You didn't touch dollars, you didn't touch your bank account, so no tax, right? Wrong. The moment that swap happens, the tax authority views it as two separate transactions happening instantly. First, you sold your Bitcoin for dollars. Second, you used those dollars to buy Ethereum. Even though it happened on the blockchain, you just triggered a massive tax bill on that Bitcoin sale. If that Bitcoin had a $90,000 gain, you owe tax on that $90,000 this year, even though you don't have the cash to pay it because you're holding Ethereum. This is a liquidity nightmare waiting to happen. Trigger number 3, spending crypto. This is the adoption trap. You use a crypto debit card to buy a $5 coffee. It seems harmless, but technically, you just sold $5 worth of Bitcoin. If you bought that Bitcoin years ago for pennies, nearly that entire $5 is profit. Now imagine doing that for a car or a house. You're creating thousands of many taxable events. So, why does this matter for you, the 10-year holder? Because your cost basis is incredibly low. If you bought Bitcoin in 2016 at $500 and today it's $100,000, your profit margin is essentially 99.5%. Almost every single penny you move is pure profit in the eyes of the IRS. But here's the good news. Because you held for 10 years, you've unlocked the long-term capital gains rate. In the United States, if you sell an asset you held for less than a year, you pay short-term capital gains tax. This is taxed just like your salary. It can go up to 37% or more. It is brutal. But you held for more than 365 days. You're rewarded with preferential treatment. Depending on your total annual income, your federal tax rate on that Bitcoin sale will be either 0%, 15%, or 20%. Most of you watching this will fall into the 15 or 20% bucket. Now, you might be thinking, 20% isn't so bad, I can live with that. But wait, that's just the federal tax. We haven't even talked about the hidden surtaxes or the state taxes that can double your bill. Let's break down the math in the next chapter, and I'll show you exactly how a $1 million exit can turn into a $600,000 reality if you aren't careful. In the last chapter, we established that long-term capital gains tax is generally capped at 20% for high earners. If you sell $1 million worth of Bitcoin, you might be thinking, okay, I will cut a check for $200,000 to the IRS, and I get to keep $800,000. Not too bad. If only it were that simple. Welcome to the world of hidden surtaxes and state liability. This is where the math gets ugly. First, let's talk about the tax that almost no one sees coming until they file their return, the net investment income tax, or NIIT. The NIIT was introduced as part of the Affordable Care Act. It is an additional 3.8% surtax on investment income for individuals earning over $200,000 a year, or married couples earning over $250,000. Now you might say, my salary is only $60,000, so I am safe. Think again. When you sell that 10-year-old stack of Bitcoin, that capital gain counts towards your adjusted gross income for that year. So if you sell $500,000 worth of Bitcoin, congratulations, for this year, you are technically a high-income earner. You just blew past the threshold. So that friendly 20% federal rate, it just instantly became 23.8%. On a $1 million exit, that extra 3.8% is an additional $38,000 gone. Poof, just like that. But we're not done. We still have to deal with where you live. The federal government gets the first bite of your apple, but your state government wants a bite too. And unlike the federal government, many states do not offer a special lower rate for long-term holds. They tax your Bitcoin gains as ordinary income, the same rate as your wages. Let's look at the worst-case scenario. Let's say you live in California. California has the highest income tax rates in the country, topping out at 13.3%. and potentially higher with mental health service taxes. So let's do the real math now. You are a diamond hand living in Los Angeles. You decide to sell your Bitcoin for a $1 million profit. Federal tax, 20%, $200,000. NIIT surtax, 3.8%, $38,000. California state tax, about 13.3%, $133,000. Total tax bill, $371,000. Your effective tax rate isn't 20%, it's 37.1%. You took 100% of the risk you held for a decade, but the government took nearly 40% of your reward without taking any of the risk. And if you live in New York City, it's even worse because you have city tax on top of state tax. However, geography is destiny. If you lived in Texas, Florida, or Wyoming, your state tax would be 0%. Your total bill would stop at the federal 23.8%. On a $1 million sale, simply moving from California to Texas before you click sell could save you $133,000. That is the price of a brand new Porsche 911 or 2 whole Bitcoins at current prices. This is why location independence is the ultimate tax hack. But you can't just move the day before you sell. The tax authorities are smart. They have residency audits. If you move to Florida but keep your gym membership, your doctor, and your dog in New York, they will come after you. So the math is clear. The bite is bigger than you thought. But there is another variable in this equation that can hurt you even more than the tax rate. It's not how much you pay, but which Bitcoin you sell. This is called the FIFO trap, and falling into it is the single most expensive mistake a long-term holder can make. Let's explain how to avoid it in the next chapter. Now that we have scared you with the tax rates, let's talk about the solution. This is where the smart money separates itself from the average investor. It comes down to one simple accounting term: cost basis. Your cost basis is simply the original price you paid for your Bitcoin. Profit equals sales price minus cost basis. To pay less tax, you want your profit to look smaller on paper. And to make your profit look smaller, you need your cost basis to be higher. Here is the problem. By default, the IRS and almost every major crypto exchange like Coinbase or Kraken use an accounting method called FIFO, F-I-F-O. It stands for first in, first out. This means when you click that sell button, the system assumes you're selling the oldest Bitcoin you own, the very first one you bought. For a long-term holder, this is a disaster. Let me prove it with a real-world example. Imagine you own 2 Bitcoins. Bitcoin A, you bought it in 2016 for just $500. Bitcoin B, you bought it in 2024 during the dip for $60,000. Today, Bitcoin is trading at $100,000. You need some cash, so you decide to sell 1 Bitcoin. Scenario 1, the FIFO trap, the default way. If you just click sell, the exchange uses FIFO. They sell Bitcoin A, the 2016 coin. Sale price, $100,000. Cost basis, $500. Capital gain, $99,500. You now owe tax on $99,500. At a 23.8% federal rate, that is a tax bill of roughly $23,600. Scenario 2, specific ID or HIFO, the smart way. Now, imagine you use a method called specific identification or HIFO, highest in, first out. You explicitly tell your exchange or tax software, don't sell my old coin, sell the one I bought in 2024. They sell Bitcoin B. Sale price, $100,000. Cost basis, $60,000. Capital gain, $40,000. You now owe tax on only $40,000. At the same 23.8%, your tax bill is roughly $9,500. Did you see that? The profit in your bank account is exactly the same. You still have $100,000 cash, but by choosing the right unit of Bitcoin to sell, you just saved $14,100 in taxes instantly. That is legal, that is smart, and that is simply a matter of checking a box in your settings or keeping good records. But here's the catch. You must have the records to prove it. If you transferred your Bitcoin from a cold wallet to an exchange, the exchange doesn't know when you bought it or for how much. They might default to a cost basis of 0. That means they'll tax you on the entire $100,000. This is why before you sell a single satoshi, you need to consolidate your transaction history. Use crypto tax software like Coinly or CoinTracker. Make sure every date and price is accurate, because if you can't prove that you sold the expensive Bitcoin, the IRS will assume you sold the cheap one, and they will send you the bill for it. So, we've minimized the tax bill using specific ID, but what if I told you there are ways to pay 0% tax legally, or ways to access your Bitcoin wealth without selling it at all? These are the billionaire strategies, and we're covering them next.
Paying 0% tax sounds like a scam, doesn't it? It sounds like something only billionaires with offshore accounts can do. But actually, the code for paying 0% is written directly into the IRS rulebook. You just need to know exactly where to look. In this chapter, we're going to cover the 3 most powerful strategies to legally wipe out your tax bill. And the first one is shockingly simple. Strategy number 1. The low-income loophole. Remember when I told you the long-term capital gains tax rates are 0%, 15%, and 20%? Well, most people ignore that first number, 0. For the 2026 tax year, the IRS has adjusted the inflation brackets. Here is the magic number. If you are single and your total taxable income is under approximately $49,450, your capital gains tax rate is 0%. If you are married filing jointly, that number doubles to nearly $98,900. But wait, it gets better, because you also get a standard deduction. In 2026, that's another $16,100 for singles and $32,200 for couples that comes off your income tax-free. So if you stack these together, a single person can technically realize over $65,000 of pure profit in a single year and pay exactly $0 in federal tax. For a married couple, that number is over $131,000. This strategy is perfect for those of you who might be retiring early, taking a gap year, or simply have a year with low income. Instead of selling everything at once, you sell just enough to fill up this 0% bucket. You rinse and repeat every year. It takes patience, but it's free money. Strategy number 2, tax loss harvesting. But what if you are a high earner? What if you make too much money to qualify for the 0% rate? Then you need to manufacture some losses. This is called tax loss harvesting. The concept is simple. The IRS taxes you on your net capital gain. Gains minus losses equals taxable amount. Let's say you made a $50,000 profit selling Bitcoin. You are facing a huge tax bill. But you also hold some old altcoins from 2021 that are down 90%. You're holding them hoping they come back, but deep down, you know they're dead. If you sell those altcoins for a $50,000 loss, that loss cancels out your Bitcoin gain. 50,000 gain minus 50,000 loss equals 0 taxable income. And here's the kicker for crypto investors, the wash sale rule. In the stock market, if you sell Apple stock at a loss and buy it back immediately, the IRS disallows that loss. But currently, crypto is treated as property, not a security. This creates a unique loophole. Note, always check with a CPA as regulations are tightening in 2026, but as of now, this remains one of the most powerful tools in your arsenal. Strategy number 3, the family gift. This is for the whales watching. If you sell your Bitcoin, you pay tax at your high bracket, 23.8%. But what if you gifted that Bitcoin to your parents who are retired or your child who is in college and has no income? In 2026, you can gift up to $19,000 per person without even filing a gift tax form. If you send 0.2 Bitcoin to your retired mother, her cost basis becomes your cost basis, but when she sells it, she pays tax at her income bracket. If her income is low, she falls into that 0% bracket we talked about earlier. The wealth stays in the family, the tax bill stays at zero. But what if you don't want to sell? What if you want to keep your Bitcoin forever, but still live like a millionaire? That is the ultimate level of the game. It's called buy, borrow, die. And that is our next chapter.
Now, let's leave the retail mindset behind. If you are holding millions of dollars in Bitcoin, you shouldn't be asking, how do I pay less tax when I sell? You should be asking, why am I selling at all? The wealthiest people in the world, from Elon Musk to Michael Saylor, rarely sell their assets. They know a secret that the tax code rewards. Debt is tax-free. This brings us to the most famous strategy of the ultra-wealthy: buy, borrow, die. Here's how it works for a Bitcoin holder. Buy. You bought Bitcoin years ago. It is appreciated massively. Borrow. Instead of selling your Bitcoin to buy a house and triggering a 37% tax bill, you go to a crypto-friendly bank or lending desk. You pledge your Bitcoin as collateral and take out a loan in dollars. The magic: receiving a loan is not a taxable event. You get the cash you need, $500K, $1 million, tax-free. You keep your Bitcoin, and if Bitcoin's price goes up, your wealth still grows. Die. This sounds morbid, but it's part of the tax planning. When you eventually pass away, your heirs inherit your Bitcoin with a step-up in cost basis. This means the IRS resets the cost basis of your Bitcoin to its value on the day you died. All those capital gains from 2016 to 2060 wiped out, tax-free for your children. Warning: this strategy has risks. If Bitcoin crashes, you could face a margin call and be forced to sell. This is for those who understand leverage and risk management. Now let's talk about a safer strategy, one that lets you sell your Bitcoin, avoid the immediate tax, and even get a tax refund. It's called a charitable remainder trust. This is perfect for the 10-year holder who wants to retire now but is terrified of losing 30% to the government. Here is the play. Instead of selling your Bitcoin personally, you donate it to a trust that you control. Donation: you transfer $1 million of Bitcoin into the trust. Because it's a charitable contribution, you get an immediate income tax deduction. You just lowered your tax bill for the year. The sale: the trust sells the Bitcoin. Because the trust is tax exempt, it pays zero capital gains tax. The full $1 million stays in the account to be reinvested in stocks, bonds, or real estate. Income for life: the trust pays you a steady income, like a salary, every year for the rest of your life. You only pay tax on the small amount you receive each year, not the huge lump sum. The remainder: when you pass away, whatever's left in the trust goes to a charity of your choice. You get income for life, you avoid the massive upfront tax hit, and you leave a legacy. This is how the rich stay rich. And finally, the geographic cheat code: Act 60 in Puerto Rico. We mentioned this briefly, but it deserves a spotlight. If you are willing to move your life to this Caribbean island and become a bona fide resident, you pay 0% capital gains tax on any new appreciation. Note: for a 10-year holder, the gains you made before moving are still subject to U.S. tax due to the 10-year look-back rule. But if you plan to hold for another 10 years, moving now could save you millions on your future growth. These strategies require lawyers, CPAs, and planning. You don't DIY this, but knowing they exist changes the game. Now, let's look at the future. What is the government planning for 2026 and beyond? Will they close these loopholes? Finally, let's talk about the elephant in the room. The reason why this video is so urgent right now, in January 2026. For the last decade, crypto tax was largely an honor system. You calculated your own gains, you reported them, and the IRS mostly took your word for it. That era is officially over. As of this year, the IRS has fully deployed its new weapon, Form 1099-DA. If you used a centralized exchange like Coinbase, Kraken, or Binance US in 2025, you were about to receive this form in your mailbox. And here is the scary part. The IRS gets a copy too. For the first time in history, the IRS knows exactly how much volume you traded. They know your gross proceeds. But here is the danger for long-term holders. The form might not show your cost basis. If you transferred your Bitcoin to an exchange just to sell it, the exchange doesn't know you bought it for $500 back in 2016. They might report your cost basis as zero. So if you sold $100,000 worth of Bitcoin, the IRS computer thinks you made $100,000 in pure profit. If you don't file your taxes correctly to correct this, you will get an automated audit letter demanding thousands of dollars. The wash sale loophole closing. Also, keep your eyes on Congress. Right now, crypto is the only asset class where the wash sale rule doesn't apply. You can sell Bitcoin at a loss on December 31st to harvest tax savings and buy it back on January 1st. There are bills on the floor right now trying to close this loophole. If they pass later in 2026, this strategy disappears forever. So, what is the outlook? The government is building a surveillance dragnet. They want their cut, but the law is still on the side of the prepared. So, where does this leave you? If you held Bitcoin for 10 years, you have won the lottery of the decade. You were right when everyone else was wrong. You survived the volatility. You ignored the FUD. Do not let poor planning ruin your victory lap. You have 3 options today. The default: sell blindly, pay the max tax, and complain about it later. The smart way: use specific ID to sell your highest cost coins first and harvest losses to offset your gains. The wealthy way: don't sell at all. Borrow against it or move to a tax-friendly jurisdiction like Puerto Rico. The choice is yours, but remember, it's not what you make, it's what you keep. If you found value in this deep dive, do me a favor, smash that like button and subscribe to Crypto Market Views 24 for more unbiased, data-driven analysis. I'll see you in the next one.